I'm delighted to welcome Professor Jonathan Haskell to this meeting. He's been Professor of Economics at the Imperial College Business School since 2008. He's previously taught at Queen Mary University of London, at the Tuck School of Business at Dartmouth College in the United States, and the Stern School of Business at New York University. His research interests are productivity and growth. As you can see from his opening slide, he's published 2 books. The co-author Stian Westlake is the former executive director of the Royal Statistical Society. He also published a number of papers in academic journals. And as well as his economic activities, he's been an external member of the reporting panel of the Competition and Markets Authority, non-executive director of the UK Statistics Authority, and until this year was an external member of the Bank of England Monetary Policy Committee. He will discuss how the economy is turning from one where firms invest in tangible assets, such as machines, to intangible assets, such as software, design, branding, and research and development. How do we measure this, and what might the effects be on economic growth? Over to you, Professor Haskell.
I shall unmute myself first. How about that? That's a little bit better, isn't it? Thank you very much, Michael, for that very kind introduction. I'm sorry about my inability to do the mute button, even after sort of all these years of being on Zoom. It's a pleasure to be talking to Royal Statistical Society. As you kindly said, Michael, my terrific co-author, Stian Westlake, is a past CEO of the RSS, and it was a job he was delighted to do and very sorry to leave. So I'm sure he has many friends in the society and hopefully on the meeting now. I'd like kindly then just to say a few words about the kind of research that I've been doing more recently, which bridges over a number of areas: academic research, practical measurement, and some economic policy as well. And I hope you'll find that of interest as well. So let me click through the slides. The title of the paper, of the little slide deck, is Intangible Investment and Economic Growth, and a couple of books, as Michael kindly mentioned, we have written on this if you want to know more. There's a link through to my website as well, and obviously happy to share the PDF of all these slides and all these clickable links. I hope will work. Okay, what's the core of what it is that we're talking about? It is this, that business has changed, and with a new look to business, we're going to need some new ways of measuring it and of understanding it. So let's have a look and see how I think it is that businesses have changed. And it is this. Factories used to look like that on the left-hand side there, but factories now look like that on the right-hand side. And that factory is, for those of you who might remember it, that is Microsoft. So on the bottom left there, let me see if I can point with the mouse. I'm not sure whether this comes up on everybody's screen. I can't see what you're seeing, unfortunately. So let me try to do that. Point with the mouse, that's Bill Gates down there, and that's Paul Allen down there. And that's a picture of them in Albuquerque in 2008, where they first started Microsoft. And that change of business has changed the shape of the world's top companies in the following way. PricewaterhouseCoopers, very well-known accountancy firm, do a leading companies of the world survey, which they measure these leading companies of the world by their market capitalization, that is to say the value of their traded shares on the stock market. Here's the data from 31st of March 2022. Apologies, I need to update this slide, but it's not going to look very different, at least in terms of the people there. You will be familiar with lots of the companies on that list. Apple, we just mentioned Microsoft, number 2. I'll come to Saudi Aramco in a moment. Alphabet are, of course, the holding company behind Google. And I bet you there'll be many people on this call who have at least ordered something from Amazon, even if they haven't heard of it. So those leading companies there are everyday companies that we know about. A word on Saudi Aramco. Saudi Aramco is the state-owned Saudi Arabian oil company. Now, if we think about those top companies and ask the question, what do their assets look like? Let's just do some pictures. So here's a picture of Saudi Aramco's assets. And you can see that they are very distinct, very recognizable things. As I say, it's the state-owned Saudi Arabian oil company. What does it do? What does it do? It pumps all the oil from the ground and ships it around. And their assets, then you can see, and you can literally see them in the picture in front of you. They are the huge machines, the massive oil drilling wells, the huge ships, the pipelines, all those kind of things, which are very tangible in a way. The assets of Microsoft. This is word 3. This is the first few lines of the dictionary bit of word 3. Word 3 came in, there it is. It's on the slide for you. In 1986, word 1 having been released in 1984. And what you can see is that Microsoft's assets look very different to Saudi Aramco's assets. And then if you go back to the left-hand side of the table, you can see that other companies like Google, like Alphabet, Google, they've probably got very similar assets, which are their assets are more similar to those of Microsoft than they are to Saudi Aramco. That is to say, Microsoft assets are intangible assets. It's the knowledge behind all that software. For Amazon, it would be the knowledge behind the software and the distribution systems. For Google, it would be their artificial intelligence, and again, the knowledge behind that, and the knowledge behind all the software that they do, and so on. And Apple likewise. One additional thing of Apple is, of course, they famously design things in California and manufacture in China. So the knowledge basis there is not only the software, but it's the management of those very complicated supply chains, which Apple are so good at. So what we're about then is we're about understanding the rise of this intangible economy. And I'll try to be a little clearer about exactly what I mean by intangibles in just a second. So this little talk, if I may, is 3 things. Firstly, the rise of the intangible economy, and I'll get into the measurement issues as well. Why is intangible capital different? So there's going to be a little bit of the economics of why the fundamental economic properties of intangible capital are different, and then something about the economic consequences. So let me get straight to it and go for the rise of the intangible economy. Just so we get on the right page, let me tell you what I think tangible and intangible investment are. Investment, according to at least national accounts, National Statistical Office conventions, as you probably know, is the spending by a company which creates a durable asset. An asset is something which gives that company a stream of services, and that durable asset which it creates on the tangible side consists of 4 different groups, which are on the left-hand side there: buildings, computers, plant machinery, and vehicles. But when we do national accounts and company accounts, basically for the last 100 years, we've known what to do, which is we send out surveys and we count the number of we ask firms what are they investing in buildings. More recently, we ask them what they're investing in computers, plant machinery, and vehicles. So we sort of know how to run all of those surveys. What are the intangible investments that firms make? Let me run through the list and then try to give some examples to bring this to life a little bit. Let's start with the top one. So R&D is an obvious intangible investment. It's a knowledge investment, incredibly important in pharmaceutical and in chemicals. Training is another intangible investment by companies. Of course, it's an investment in some sense in human beings because it's training them to do things, but companies spend lots of money on that. Likewise, design. I mentioned business processes. Again, think of Apple's incredible ability to be able to launch a new Apple phone and have literally millions of them all ready for you when you want to go and buy it the following day. Brands and marketing, another important intangible asset. Certainly, there's a whole sub-discipline who try to work out the value of Nespresso, the value of Coca-Cola, and all those various other brands. Artistic originals is the one there. There's a picture of Britain's most famous innovation, namely Harry Potter. Harry Potter is, of course, an idea. It's not sort of tangible thing. It's a notion. It's an idea. It's both the book and the movie scripts. And we will see as well some other intangible assets. And finally, software and data, which I mentioned before. Okay, so a couple of examples. COVID. You might say, well, isn't COVID an application of this in the sense it's an invention and therefore it's the R&D which produced the COVID vaccine? Well, it is, but of course what we learned is not only did these firms have to invent the vaccine, but they actually had to ship it around to people and produce it, both of which turned out to be very complicated. So I think it's a synergy of two different intangible assets, namely R&D and the business processes around the manufacture and the transport of the vaccine. Let's do a second example. We can't run any kind of seminar without mentioning artificial intelligence. So let's start with that. So the obvious notion is that artificial intelligence has got something to do with very fast computers. Indeed, that's what a lot of these companies are investing in. But it's more than that, of course, because what these artificial intelligence programs do is they use incredible amounts of software and they scan vast databases as well. So that's an example, I think, of how thinking through intangibles helps you think about artificial intelligence. In this case, the fusion of both tangible investment and intangible investment as well. Now, all of this stuff, I think, is more interesting and more challenging because it's all hidden. And I'm going to say a few more words about this in a second, but just to introduce these, from a series of measurement conventions, which I'll explain in a moment, GDP still doesn't include most intangibles. As I mentioned, we've been counting tangible investment for, I said 100 years, for 80 odd years, certainly since the 1940s. More recently, we've been counting intangible investment. When I say we've been counting, I'll explain what I mean by that in just a second. Software, artistic originals and R&D. But there's still a load of other intangible investments like training and design and so forth, which we don't count. On the company account side, we hardly do anything on company accounts either. And as a consequence, company accounts are particularly uninformative about many modern corporations. Here's a graph taken from Ocean Tomo, who are an American consultancy. The left-hand graph tells you, take all the companies in the Standard & Poor's 500, that is to say the top companies in the US, in 1975, and ask what fraction of their assets were tangible and what fraction were intangible. And the answer is 80-odd%, 83% were tangible back then. Now on the right-hand side, take all the companies in the Standard & Poor's in 2020 and ask of those top companies what fraction of their assets nowadays are tangible. And the answer is only about 10%. And that goes back to the graph that we saw earlier on. Those typical companies like Microsoft, like Amazon, companies like that, hardly any of their assets are tangible assets. They're mostly intangible assets. Now, to a statistical community, that raises an important question, which is how are we going to measure all of this stuff? So let me just talk through some of the measurement conventions in a second. This is no kind of econometrics or no, it's sort of sampling statistics, but these are really measurement and accounting conventions that I'm talking about here as well. And I ask on the left-hand side, how do these changes show up in the recorded data? Now, one way of doing it is simply just to go to the industries concerned and extract various measures. And that's a lot of what these excellent consultancies actually do. So on the right-hand side from the very recently reported, this is from a couple of weeks ago, Mario Draghi, the ex-chair of the European Central Bank, did a report on EU competitiveness. And there are various diagrams in there about how essentially the EU, according to him, is lagging behind the US in a lot of these technology issues. And they're full of diagrams essentially from micro, sort of quite detailed studies of individual industries. In this case here, the share of biological medicines sold in the European economic area, according to whether the company concerned is an American company or a European company or Swiss or UK or whatever it might be. So that's sort of one way of getting at these various changes. But I think as an economist, whilst I like those measures, I want to be sure that I understand how it is that in national accounts, that is to say in GDP, these measures show up as well. And so let me, with some apologies for a bit of notation, quite a lot of notation actually, walk you through how GDP works with and without these technological changes. Okay, now, Apologies for this sort of busy slide here, but I need to set this up in order to understand how we're going to look at all these things. Okay, now what I'm going to do here, and I'll try and point with a cursor, so I hope you can see this. We've got GDP with 3 sectors here. And the 3 sectors, imagine this is an agricultural economy. And the 3 sectors produce fertilizer, the fertilizer sector, then there's a sector producing tractors, and then there's an agricultural sector. Let me start with the fertilizer sector. The fertilizer sector produces Z units of fertilizer, which it sells for a price PZ. And the only thing it does is it employs a load of workers. So it employs L workers and it pays them a price PL. So that's the wage of the workers per hour or per year or per month or something like that. Right? The tractors sector produces new tractors, new tractors at a price PI, and it pays just workers in the tractor sector a wage there as well. So that's the wage PL and the number of workers in the tractor sector are LI. Sorry, there's some of the T subscripts are in time T, and some you can ignore all of those. What does the agricultural sector do? The agricultural sector brings all this together and grows stuff, I don't know, apples, let's say, which sells lots of apples, so that's consumption. It sells them for a price PC, so that's a price per apple. And so therefore for the agricultural sector, its final selling price has got to cover everything that it does. It's got to buy in a load of fertilizer, so that's the first PZZ, which I hope you can see on the cursor now. It's got to employ some workers itself. And then it's got to buy in a load of capital. It's got to use the capital of the tractor sector, and it's got to pay for those capital. Now, when we do value added in the economy, we want to make sure that we add up all these different sectors. So the sum of value added in the economy is going to be, just by definition, the value added in the fertilizer sector, the value added in the tractor sector, and the value added in the agricultural sector. How do we do that adding up? If you've ever done any economics before, you'll know that what we do is let's take agriculture as an example, we take the final receipts of agriculture and we subtract off everything that gets used up in that sector. And the stuff that gets used up is the fertilizer. You begin with loads of sacks of fertilizer. At the end of the year, you don't have any fertilizer anymore if you're a farmer. You've just used it all up. You've still got your workers and you've still got your capital, but you've used up all of the fertilizer. That's essentially has been transformed into something else. So value added in agriculture is not the value of the apples. It's the apples minus the fertilizer, which is in this case, as I say, used up in order to make the apples. So here's value added in the whole economy. It's the apples minus the fertilizer, as I mentioned. That's value added in the agriculture sector. The tractors are assumed just to use labour and no fertiliser or anything like that at all. And likewise, the fertiliser sector is assumed just to use labour and no fertiliser as well. So the value added there is actually the final output in those sectors. And so you can see that the fertiliser cancels out, which tells you that value added in the economy is simply the value of the consumption and the value of the investment. Notice it's not the value of the fertiliser, but that's right, because the value of the fertilizer is inside the value of the consumption, the value of the entire of the apples. Just the fertilizer is all used up in the consumption of the apples. One more thing is that what is rather convenient is that the sum of the value added in the different sectors adds up to the consumption and the investment, but it also adds up to everything that's being paid for the labour and capital in these different sectors. So the payments of labour and capital in the C sector, in the consumption sector, the payments of labour in the tractor sector, and the payments of labour in the fertiliser sector. And the reason for going through all of this then is that GDP is available to compute in 3 different ways. The sum of industry value added, the output in the final use sector, so that's consumption and investment, which are not used up, and then the sum of payments to capital and labour. Right. With all of that in mind, we're going to do the next thing, which is we're going to add a 4th sector, and the 4th sector produces new knowledge. Let's suppose they produce patents, which only use labour, and they sell that knowledge for PN. We've just done the fertilizer and the tractor sector, so I'm now going to add the knowledge sector. And the knowledge sector employs LN workers, paying them PL, and sells the knowledge at a price PN times N. Now we have to work out how we're going to treat that knowledge in the agricultural sector. And there are two ways to model the agricultural sector, as the slide tries to make clear. The agricultural sector either buys the knowledge and uses it all up, or it buys the knowledge, but it's a lasting asset. Let me just go through these two equations and then relate it to what it is that's actually done in the accounting literature. So this gives two equations for agriculture. Firstly, if you want to treat it as using it all up, then the final, this will be the value of the apples, has got to be the fertilizer, the labor in the agricultural sector, the capital in the agricultural sector, and then the price which is paid for that knowledge. If, on the other hand, it's a lasting asset, then the value of the apples has got to balance the fertilizer, which is all used up, the labor which is used, and the capital which is used, and then the rental price, in other words, the price that the agricultural sector is going to pay for using the knowledge year after year after year. So you could think of this price here as being, for example, a license fee. The agricultural sector buys the patent, uses it all up in a year, and it buys the patent for PN. Not a license fee, the price of buying a patent. Or you could think of this a figure here as being a rental fee, namely, if it's a lasting asset, it's how much the agricultural sector has to pay year after year after year after year to keep using the good. Where does that take you? That takes you to two places. I'm sorry about these arrows at the bottom. I'll explain those in a second. So let me write down GDP when knowledge is used up. GDP when knowledge is used up is the sum of the value added, which is consumption investment, which is what we saw before. The sum of these factor payments, which is the labor and the capital. On the other hand, if knowledge is a lasting asset, then you have some extra GDP. And the extra GDP is the fact that there's not only the payments to the tractor sector, but there are payments for the use of the knowledge. And those are balanced off by the payments that you're making, not only to the owners of capital, but the owners of the physical capital, but the owners of the knowledge capital as well. So the point behind all of this is that once you start counting GDP with a knowledge, when you have a knowledge producing sector, you get a different amount of GDP, and that's the point of the blue arrows. You get extra investment and you get extra payments, in this case, for the use of all that knowledge. Let me say what some of the implications are of all of this, and the above two equations just repeat what you've just seen. Now, in practice, accountants find it extremely difficult to actually measure knowledge investment, especially, as it says on the slide there, if its own account. So something like design, for example, if that's just done in-house by a company, you can't just ask a company how much did you buy in from design consultancies, because they don't know the answer to that because they do it all in-house. In which case it's much harder to actually ask the firm how much did you spend on the in-house design. I say it's much harder. Well, questionnaires typically don't say anything, don't really talk about all of that. They mostly ask firms about what they've bought in. And the reason for saying all of that is that this is why many of these knowledge investments, these intangible investments, are not counted. They're not counted by management accounts, and they're often not counted by national accounts as well, essentially, as I say, because it's just too hard. And because they are not counted, then the GDP portrait is the above measure on the very top there, which misses out all of this investment, whereas what in some sense should be measured would be the GDP measure on the second line, which includes all of this investment. So the key point behind all of this is if your measurement convention, your statistical measurement convention, does not count all of this, then you're going to miss something about GDP. Now, what is it that management accounts actually do? Those of you who work with management accounts will know that there is often a measure of what is often called an intangible amount, and that is something called goodwill. I'm not going to get into the details of management accounting. I'm happy to do that afterwards if we talk about it afterwards. But goodwill is basically a very partial measure of all of this stuff, and it's just not done very well. Finally, I think in general, as I'll show you in a minute, GDP is moving towards including much more of these knowledge assets. The world is becoming more dominated by software, by R&D, by the production of artistic originals. And indeed, in the second line there, design and market research and so forth. But as I mentioned in the slide earlier on, those are not at the moment included in the measurement of investment. If those intangible investments are becoming more important, GDP is missing them, that gap's becoming more important. And again, this clickable link to the book. And one way of thinking about that is that if we're going through a technological revolution, artificial intelligence, let's say, there might be a lot of this intangible investment going on. So there might be a lot of PNN. And if, again, I hope you can see the cursor, if PNN is very high, but we're not measuring it, then measured GDP is too low. Finally, I've talked about free goods as well. Many of these digital goods are for free, so it's very difficult to know what the price index of them is as well. Okay, so that takes one to what the research program is around this area, if you think this area is important, which is what my colleagues and I have been involved in. Find data on these intangible assets, find data on the bought-in intangible assets, e.g. ask firms how much buying in of training, and I mentioned how much design they're buying in, but also go into firms and find out what their own account expenditure is, what they're spending in-house on investment and on design and so forth as well. We've got to find some price indices for this as well in order to try to distinguish between spending in pound terms and spending in volume, real terms. And then we need to incorporate this into national accounts. So that's the research program. Let me, in the last few slides, take you through to what it is that we've discovered, or is we think we've discovered on the basis of this research program. So here's a little bit of data for you, which essentially is the outcome of the detective work that I just described. So we'll start with the US, where we've got the longest time period, and you can see the red and the blue there. Let's start with the blue. The blue is the share of GDP accounted for by tangible investment. That's on a declining trend. The red is the share accounted for by intangible investment, and you can see that that's on a rising trend as well. Indeed, in the US, every a dollar of investment today of tangible investment, is much less than a dollar of intangible investment. And that's why we think that intangible capital is the capital of the 21st century. Let's look across countries. Here is tangible investment across different countries. You might be familiar with so some of this. That's mostly falling, grouped together around in the late 90s. It was sort of 10 to 16%. It's now around 12% in all those different countries. Here's intangible investment, by contrast, rising very significantly. And these low countries here are countries like Italy. Spain is also down here as well. So there are interesting cross-country differences in the amount of intangible investment they're doing. And again, you can see that the intangible investment now around 16% is higher than the tangible investment at around 11% there as well. Okay, you might ask, well, what about R&D? So here's some measures of R&D as a proportion of GDP, and that's a number which is very often quoted. And you can see those are numbers like 3, 4, 5% here. So I'm not going to say that R&D is unimportant, but it's just one part of the overall picture. What happened in the pandemic? Did all this stuff go away or what? Well, actually, interestingly, in the US, there's been a big increase in software investment in America, not matched, interestingly, by that in Europe. And presumably part of that is because working from home and all those kind of issues has required the kind of investment in software and indeed in computer hardware that is basically on the screen in front of us, the Zoom software which supports this seminar and the hardware upon which we run it. Okay, So that's something about that. Let me say something about the economic properties of intangible capital and why I think they are interesting. So there are 4 economic properties. I'll try and go through them fairly quickly and then tell you something about the economic consequences and then stop. So the first property of intangibles is what economists call scalability. Here is a tangible asset on the left-hand side, namely a London taxi cab. If the London taxi cab has got 5 people in it and wants to take a 6th person, then you have to buy another taxi cab. Here is a different taxi company. If that has 5 people, that company, and they want to handle a 6th company, they don't have to get a brand new taxi cab. In fact, they can use exactly the same intangible asset as before, the intangible asset being, of course, the software which runs Uber. So the first property of intangible assets is you can scale up. So companies like Uber, Microsoft, LinkedIn are going to get very big. Second property of intangibles is, I'll be brief about this, is what economists call sunkenness. That's the ability to get the investment back once you've made it. When Nokia went bust, it had 2 assets. It had some assets on the left, which are essentially its buildings, which it sold and got all the money back. But it also had a software asset, namely the intangible asset, which it found unable to sell. So intangible assets, as it says on the slide, are harder to sell off. Third property of intangibles are spillovers. Back to Saudi Aramco. If Saudi Aramco have a whole load of oil drums and a whole load of machines and everything, and they want to use it, I can't use it. On the other hand, once the iPhone released their design, an intangible asset, then everybody else can use it. And essentially, after the release of the iPhone, more or less all of the other smartphones looked exactly like the iPhone. That is to say, the design features of the iPhone, that intangible asset, spilled over to the other companies. Final property is synergies. The EpiPen, which is a wonderful invention which stops people from getting anaphylactic shocks, is, we believe, an example of the synergies behind intangible assets. Of course, it is backed by a patent, but the patent ran out around 100 years ago. So that's part of the intangible asset. But it's also got clever design. It's very easy to use. It's got a terrific brand. There's lots of marketing and very good distribution. And there's lots of training on the use of the EpiPen as well. So it's the mix of those intangible assets together which we think are responsible for the success of the EpiPen. Okay, so having said a little bit about the economic properties of those, let me, in this last section, say something about the consequences of an intangible economy and why we think they're kind of interesting given those economic properties. Firstly, as a consequence of scale and synergies, you might imagine that the big companies are going to get really big. As we've seen companies like Uber who are scaling up using their intangible assets. And here indeed is a little confirmation of all of that. This is some OECD data which asks the question, how has the market share of the top 8 firms in an industry evolved in the intangible intensive sectors and in the low intangible sectors? And you can see that it's gone up, that share of the top firms in the intangible intensive sectors, but stayed around the same, maybe gone up a little bit in the low intangible sectors, suggesting that what's going on is that those firms are using scale and synergies to get bigger. Likewise, the gap between the leading firms and the laggard firms has also gone up in the intangible intensive sectors and stayed about the same in the tangible intensive sectors. So scale and synergies give you more concentration in industries. Spillovers and synergies give you what economists call agglomeration externalities. This is a graph of the productivity advantage of large cities in America. That's New York on the right, on the far right there, and that is smaller cities like Madison and Little Rock on the far left there. Those agglomeration externalities, that is to say, the benefits of being situated with other like knowledge workers are going to rise when are going to be realized in cities. And so the large cities get a productivity advantage. Likewise, managers are going to become increasingly important. You might wonder why there is the cult of the manager, and people know as almost household names many of these managers here. There's Elon Musk on the bottom right, the late Steve Jobs on the left, Jack Welch on the top right there, and Jeff Bezos from Amazon in the middle there. Part of the reason why people nowadays know managers in a way that maybe in previous generations nobody knew who any of these people were, is they become more important in the running of those firms. Why does intangible investment vary across different countries? I had a little bit of a sense of that in the earlier diagrams. So let me say a little bit more about this. So here's Spain on the left-hand side, which has got a high share of tangible investment. This is an average over the 2000s. A high share of tangible investment, but a very low share of intangible investment. There's Sweden on the right-hand side, which is the opposite, a high share of intangible investment and a rather lower share of tangible investment. So why do those things vary? Well, they're correlated with some costs and benefits indicators, which economists find very interesting. So on the left there, the tangible investment share seems to go up when employment market regulations are more strict. That's the horizontal axis. And then also on the left there, but on the second panel of the left-hand diagram, the intangible investment share seems to go down, interestingly, when employment markets are more strict, suggesting that in those countries where there's a lot of strict employment market legislation, like Italy, Spain, they're going to get low intangible investment. Likewise, on the right-hand side there is another index of service sector trade restrictiveness. This is obviously important when we think about Brexit. The size of the market is going to matter for intangible investment as well. So a country like Austria, for example, on the right, which has got rather high service trade restrictiveness, has got relatively low intangible investment. Finally, public R&D seems to be important, as well as a broad correlation between those countries on the left, like Italy, Spain, spending rather little on intangible investment, and those companies on the right, Finland, Sweden, spending a lot on intangible investment and spending a lot on public R&D. Okay, let me stop. Just to summarize, the rise in intangible investment, I've tried to document. I've tried to say something about their different economic properties and some implications for measurement, implications for competition. I've hinted at the public investment in science as well, and the importance of cities. I didn't say anything about financing, but financing these intangible investments is going to be important as well. So let me stop there. Maybe I'll stop sharing my screen and turn back to you, Michael. Thank you very, very much.
Sorry, I was muted there. Yes, thank you very much. We've got another 20 minutes, so there's plenty of time for questions. Can you please raise your hand if you want to ask a question? Everybody's stunned into silence. Ryan?
Hello, can you hear me there, Michael?
Yes, Ryan.
Wonderful, thank you. No, thank you, Professor Haskell, for a wonderful talk. Very interesting, really appreciated the time. And yeah, some fascinating reflections there. I'm wondering if, given that there's going to be a major release of the System of National Accounts in 2025, whether you're aware of the extent to which some of your research, some of your findings might be able to be incorporated in, what would form the international standard for the compilation of national accounts for potentially the next 15 or so years.
Yeah, thanks very much, Ryan. I've been too busy at the Bank of England for the last few years to follow this in detail. The new release of national accounts is going to incorporate, I think, branding as an intangible asset. So, the value to Coca-Cola of their brand, the value to Nespresso and things like that. I think that is on the table. I'm not sure whether that's been voted on or decided, but that's part of the general move to incorporating more intangible assets in at least national accounts that we've seen. As I mentioned, the statistical community, the national statistical community, put in software a few years ago We've been very go ahead in the UK, actually. We've had artistic originals in the accounts for decades now, probably before many other people. So we've managed to have captured, Harry Potter and things like that. So I think in general, there is a movement towards incorporating all of this more in the accounts. The big thing, I think, which is very, very hard, is the value of databases. Because surely, again, if we think about artificial intelligence, what does artificial intelligence do? It runs these fast computers and it runs incredible software, but they are scanning ginormous databases, to get translation things going, or face recognition, or sort of something like that. So those databases are now, it seems to me, a very valuable intangible asset, and counting that is extraordinarily difficult. And I'm just not sure how much national accounts are going to move towards trying to make further efforts in that area. It's a very, very hard area, but it feels like an incredibly important area given the way that the economy is evolving.
Any more questions? Was that Tom King?
I wanted to ask about indirect measurement, because these are intangible. The direct information isn't available, which has come up in the work on measuring research and development. So there was the contrast between estimates available from ONS with what the HMRC was producing on tax credits in this respect. And, we're aware that tax credits may or may not be claimed exactly for what they are intended. I wondered if these indirect measures make it difficult to be sure what we're actually measuring with intangibles. But I also wondered, because you mentioned data specific, whether there are indirect ways of measuring data as an asset, just because of the vast energy costs of data sets, and whether there are ways of measuring the value of data just because training models seems to be substantially about the amount of data. This could correlate with the size of spending on data sets.
Yeah, thanks very much indeed. Really interesting set of questions there. Let me step back for a moment. Look, in general, the trouble with these, from a sort of statistical point of view, the trouble with these intangible assets is they tend to be internally generated for entirely understandable reasons. If I'm a pharmaceutical company and the whole value of my company is the secret formula that I'm going to produce for my COVID vaccine or my cancer treatment or whatever it might be, of course I'm probably going to generate it internally and be very, very careful about not letting that knowledge slip out. And so the trouble with internally generated assets is that as statistical agencies, we just find it very hard to count all of that. We know exactly what, pretty much exact, I shouldn't say exactly, we know pretty closely what it is that British Airways are doing, because they don't make their own planes, they buy them all in. And so as long as we can get British Airways to answer its questionnaires, and I'm sure they're very good about this, we know what investments they're making when they buy in all these planes. It's much, much harder to know what investments, I don't know, Amazon are making or LinkedIn are making when they develop their own software and their own artificial intelligence mechanisms and so forth as well. So I think that's just basically another way of saying what you're saying. Now, the tax issue about whether I would regard as being a sort of somewhat of a cross-check. Namely, you could go to the tax data and ask what sort of tax incentives are being claimed for. But I think statistical agencies are normally pretty shy about doing that and prefer instead to either administer their own questionnaires and walk firms through how they should estimate these internal costs, or go to, I don't know, the labour force data and see how many computer programmers a company is producing, or how many scientists a company is employing, or how many scientists a company might be employing. Those numbers turn out to be much less, of course, than the tax credit data. But I think that highlights, how hard all of this is, and the extent to which statistical agencies have just got to be very, very careful about not just relying on one data source for all of this.
Right. Perhaps I could slip in a question. You're measuring these things presumably at current prices. How do you deflate it so that you can get change at constant prices?
Right, as if it all wasn't difficult enough, that's even harder. And so what we try to do is we try to look for some plausible kind of deflators. So one way, for example, would be to go to, I don't know, the management consultancy industry and try to look for the price deflators in the management consultancy industry, which is, what the statistical authorities are having to do in any case. But getting price deflators for these things is extraordinarily difficult. And that in some ways is the sort of key measurement uncertainty, I think, behind all of this, because those different deflators make a very big difference. So, Michael, you ask a good question, and that is something which, I think as a statistical community, we need to do much more work on.
Can I thank everybody for attending? Can I thank Professor Haskell for a lovely speech? And thank you to those of us questions.